Good morning, everybody. Welcome to Friday. Welcome to the Flow Show. Oh, the end of the week at last, but we still got plenty to do. Morning, Kay. Morning, Stel.
Morning, mate. Morning, everybody.
Hello, TGIF.
How are we all doing?
It's been a long week.
It's been a long week. It has been a long week. I think we get half a week off next week because it's usually quiet the week after non-farm, and then we're right into the last part of the year with all the central banks dropping down. So yeah, a few weeks to go, and then it's Christmas, folks. We can all have a nice break.
Oh yeah, I can't believe my Japan got through to the next round.
Oh, what an unbelievable set of matches yesterday, eh? I'm not mentioning anything to Kay.
No. Well, anyway, I said it before, right? I mean, now they are happy. They can go home, the old crew, and relax. Watch the World Cup in front of their telly, just like us. But I'm happy for Japan. My second home country. I consider
of
it.
course.
Happy.
Yeah.
Yeah, amazing. I was watching both games, one on my phone and one on the TV screen. It's amazing the way it swung around there. And yeah, Germany gone as well, which we're always happy about. So yeah, all the fun of the football, and we'll see what that brings. Right, before we start, don't forget, folks, if you haven't already, have a little guess at the non-farm payrolls competition. You can access that from the Twitter link I've just put in the chat there. You can win, or 3 lucky people can win a free month to our chat room and platform. You can come and save all the goodies we have on offer, join the community. So check out that link there. I'll post it again towards the end of the show. Right, let's get stuck into things. What should we do today? Let's look at the data today again, because it has been another stack of data out. Lots of news. Obviously, dollar's taking an absolute pasting, particularly dollar yen. Yields dipping. The data just keeps coming and coming and coming, and none of it is overly positive. Challenger layoffs only up a small 416% year on year. Job cuts came in at 76,800, higher than the 33,000, 34,000 last month. A big chunk of that was through tech, and now we've obviously heard from the likes of Twitter, Facebook, so on and so on, some of the big tech companies cutting workforce. So no surprise that the tech accounted for, I think, about 52,000 of those 76 job cuts announced. So no surprise there. Now, this report, layoffs, it's companies' intention to lay off. It doesn't necessarily equate to actual job losses. So when Facebook or whoever announces they're looking to cut 2,000 from the workforce, it doesn't mean all those people get cut and end up unemployed. Some can get recommissioned to other roles or whatever. So it's not an exact cut number equals complete redundancies and that sort of thing. Not redundancies. Yeah, redundancies. Yeah. Continuing jobless claims came in a little bit worse than expected. Again, we're just seeing that trending. The initial jobless claims was a bit lower than it was prior, but as you can see, the 4-week average is still ticking up. It's not running away, but the trend is definitely moving higher. Same say there with continuous jobless claims as well. Then we got the big PCE data, and right on Powell's numbers, wasn't it, Kay?
Yeah, exactly. He gave us the note the day before, saying that their models would show were showing 6 and 5 respectively for the headline and the core. So that's exactly what we got.
Yeah, exactly. Now the core looks like it dropped 2 pips, but that was only because it got revised up from 5.1 to 5.2. Otherwise, it would have only been down a pip. It's still down. The headline PCE number year on year was down 3 pips there, also a revision. Largely following the CPI numbers where we're seeing inflation come lower. It's not a one-on-one or one-to-one correlation between PCE and CPI, but the trend is your friend, and we're seeing that coming down as well. But on the flip side, there's maybe a bit of surprise in the spending numbers, income and spending numbers. Slightly higher on the month, 0.7% versus 0.4 expected, 0.8 as expected, up on the 0.6 prior. So still there's some evidence that incomes are rising and that spending is continuing. Now, obviously, keeping pace with inflation is another question altogether, but the fact that these numbers are still positive still shows that, you know, the consumer isn't really under the cosh just yet, but a long way to go on that already. Coming over, where should we go? Let's have a look. So more PMIs, obviously yesterday as well. We've got the S&P Globals from Canada and the US. Canada doing a bit better there, but still in contraction. The US, a pip up on the flash number there, 47.7 versus 47.6 in the flash, and the October number, so largely up changed there, 47.6. And the ISM, now that was a bit ugly yesterday as well. Employment into contraction, new orders much worse. The PMI itself into contraction. Prices paid, a big drop there, 43 from 46.6 prior. I was expected at 47.5. The numbers there pretty much following the rest of the PMIs that we're seeing globally as well, all into contraction. The inflationary measure there, prices paid dropping, employment dropping. So big numbers there potentially for what we're looking for in employment, the jobs market, and further falls in inflation. And the market, the pivoters, the doves, whatever you want to call them, have firmly got the bone between their teeth now, as we've seen in some of the moves we've had so far. Coming over to this morning, there we go, or latter part of the night. Some data out from Australia as well. Retail sales coming in as expected, down 0.2%, a little bit soft there. Germany got some price data as well. Their import prices down, not as much as expected, but still a drop. A little higher than expected on the year-on-year number, but still down from the 29.8 prior. Activity overall, exports down 0.6%. Imports down 3.7%, so just a little bit of a drop in activity there coming in. Unemployment in Spain, that was down 33.5k, so a decent number there from Spain, beating expectations, and that's it. Now, obviously, the big numbers today are going to be the non-farm payrolls, as mentioned. Expectations are for 200,000. There, so that's set between Bloomberg and Reuters agreeing on the same number. Unemployment rate set to stay unchanged. What's it all going to mean really for the non-farm payrolls? As I said yesterday, particularly after Powell, I don't think the data, well, when I say that doesn't matter, I think good data isn't going to matter to the market at the moment. If we get a gangbusters 300k non-farm payrolls, dollar's going to rally. I don't think that's going to last. I think it's going to get hit hard. The market is now questioning how far the Fed is going to go on rates, and good data is going to get sold into, as far as I'm concerned. So we'll see what happens with that later, and we'll talk about non-farms later as well. It's also double bubble with Canada jobs as well, so double risk there if you're playing with the loonie. Anything in the data seen or awaiting that you want to just talk about quickly before I get into all the headlines, guys?
Yeah, to come back to Powell and today's NFPs, we had the hint at what they consider as growth or destruction for jobs, and that's the 100k line. So I reckon for an immediate move, I reckon the market will still, because it's still fresh in the memories, look at the number. If it's well above 100k, it may give some sort of relief, but then we have to look at the unemployment rate, of course. so that is one number that I'm keeping in mind going into those NFPs, because he gave us the hint that that is what they're looking at for the good or bad. And one other thing before we really start to look at other stuff, I've got it's a bit of a, I'm wondering if the data continue to be bad, if stocks can continue to rally, because I have got in mind, and it's the case for every kind of recession also, that at one stage always speak conditionally, if the data continue to go down and get ugly, are we not going to go somewhere running into an inflection point where bad data are going to be bad for the currency, but also bad for the equity markets? And I wonder if in the state of the minds right now, if we are not too close, or if we're not close to such inflection point, because we have seen, yes, the stocks have rallied, but then despite the dollar getting sold off more, we stopped on the S&P, for instance, around 4,100, and for the time being, we are not taking that hurdle. So it's just a question that I have in my mind, or something that I'm looking at, is, are we close to an inflection point where saying like bad numbers are now really bad? So that's one thing that I'm thinking about.
I can try and answer that. First of all, you're showing your age. Okay, this is how things used to work. This is how things used to work. So you get economic growth, you get spending, you get inflation, and equity indices go up because companies create more, produce more, sell more. Right now, that's used to be the old normal. And if you have a recession, then obviously the inverse applies. So they create less goods, less demand, prices fall, inflation falls, and equity indices fall. The problem is that we have the Fed and the actual central bank intervention since 2008, which has continued, actually no, since early 2000s, where when we have a recession or when we have really deep trouble, they go in and they start buying everything. This didn't used to be the case. Remember in the 90s, this didn't happen. So they would allow the economy to fall. They would allow equity indices to drop. Remember 2008, huge drop in the indices. And that's what used to happen. So your reasoning is perfect. But the question is, what do we think the Fed and the other central banks are going to do when we see the recession, which is coming? What are they going to do? Are they going to leave things alone, or are they going to start, throwing the kitchen sink at it? I fear that they're going to start intervening again, and they're going to start saying, oh, we're going to slash rates and maybe start QE again and all that crap. Pardon my language, but that's why the markets, I think, are really liking the fact that the data is turning, and that we're seeing inflation. Look at PPI in the Eurozone. You have it there on your screen, 10% below the expectations year on year. And this is going to keep plummeting. All this is going to keep dropping. Demand is slowing massively. Housing is slowing, is going down. This is not good. We're heading into trouble. The question you need to ask yourself as a trader or as an investor, maybe more I think is more appropriate, is what do you think central banks are going to do? If they're going to start stepping in again and buying everything, then just go long and forget everything, right? That's a question. Yeah.
No, I agree. And I would love for the picture to change. I've been saying on it for months, I can't understand. It doesn't compute in my head why stocks would rally into a recession. And we've been asking this question. I've been asking this question probably since about 2015. But yeah, I think this time is different. Just okay. I think this time is different still. I don't think QE is coming out on economic weakness. That's supposed to be an emergency tool. They used it for COVID. They probably shouldn't have. But I don't think they'll use it again. And I think that's the big point for stocks. If a recession kicks in, if rates start getting cut and the market starts going, oh, QE's coming, and central banks turn around and go, oh, no, it isn't. That's when you get a big reflection point, if you like, for stocks. Sorry, Kay, go on, mate.
Yeah, I completely agree with what Stel was saying, and that is the old method of looking at. but we are, and we can, I guess we can all agree on that, since 2008, and then especially over the pandemic, we are in extremely accelerated economic cycles, right? Where we used to have 7, 8 to stretch it to 10 years economic cycles. We now had a full 10360 in what, 3 years time, 2 years time. So it's just a question that I'm asking myself, like, is there going to be an inflection point that it happens, or is the market just blindsided, and is there enough liquidity in the market to just continue going? Because that's the thing, they have tightened the rates, they have started QT, and then if we see financial conditions have not really tightened over the past couple of months, which is, in my personal view, as a dinosaur, is a little bit of a strange one as well. But yeah, I mean, the thing is, it's just a question: are we going to reach this inflection point? Yes or no? And I really keep the option open. I'm not saying it's going to happen, but I think we should just keep it in the back of our mind and tell people that that is what in the Stone Age used to happen in economies and markets. So there we go. That was just a quick in between.
Yeah, good point, mate. Good point from the pair of you. Right, let's get into some of the headlines, and then we'll take a look at all the prices and whatnot. China, Beijing, not too long before we started the show, said that buses and subways can now not reject people with no COVID results. That's one of the conditions they had in place, that if you didn't have a COVID pass or test result, you can't get a bus or on the train. They're now knocking that back. Believe it's starting in the next week or so, next couple of days. They reported cases of just under 34,000 for yesterday. That's below the just under 35,000 the day before. So things easing off a bit there on the case front anyway. But still, the reopening ball is rolling now. We just need to see how far it rolls before they say enough's enough. Right, some interesting stuff from the BOJ. I'm going to start with probably the less interesting stuff. Kuroda was out saying that the global economic slowdown has been observed, and Japan's inflation is expected to decelerate from 2023. Old words there. Now, a couple of things. Here's some numbers coming out from Deputy Governor Amamiya. He said, even if the Bank of Japan incurs short-term losses on its asset holdings, that won't affect its ability to guide monetary policy. And if yields rise by 1% for Japan's entire yield curve, that will lead to an evaluation loss of 28.6 trillion yen in BOJ's bond holdings. Now, that's quite significant, because a lot of the market is asking, the Bank of Japan owns over half of Japan's government debt. What happens if yields rise? They're obviously going to book a huge loss. Well, there's a bit of a number, an evaluation loss. It doesn't mean a hard loss, because they can just sit on stuff and just let it roll off, whatever they decide to do later on. But a book loss, 28.6 trillion yen. I don't know if we've heard any numbers like that previously from the bank. Kay, do you know?
I don't recall. Honestly, don't recall to have seen such numbers. I don't know.
No, but should we make the distinction between a book loss and an actual loss in terms of what they might do if, we think that
it's going to be in the case of a central bank, like look at what happened to the S&P. It's always going to be just a few numbers on a website, I reckon.
Yeah, cool. Now there was
the next Japanese government stimulus package could be for the Bank of Japan to plug the hole.
Yeah, taxa. Oh, that would be put them in a right pickle. Now, board member Tamura said that the bank should conduct a review of its monetary policy framework, according to the Asahi paper, and whether the BOJ needs to tweak its ultra loose monetary policy will depend upon the outcome of that review. The timing of the review could come soon or somewhat later, and which will depend on the price, wage, and economic outlook. Could that be some big news there, that they're going to look at the framework and maybe look to tweak something within that?
Yeah, but what do they understand? Is it the way that they look at CPI? Is it just the way that they look at their rates or ETF buying? They've been in the market overnight to buy ETF for the first time in 6 months. It's there's been some vague talk, but again, it's extremely vague, that they could be looking at the CPI target at any time. But I've heard such talk since Abe came on, and we are like 10 years later, and we're talking about it again. Yeah, we've been saying they might be doing something. I have the impression that the window is starting to close, because elsewhere data are starting to turn. So they may have missed the perfect occasion to do something, but yeah, what are they going to change to the framework is an open question, right? Okay, they could change the way they approach YCC. They could change the way they buy non-stop the JGBs. Like, for instance, put a cap on how much of the market they want to own, for the good of the functioning of the market. There's many ways to change the framework, or to make some tweaks to it. But really, I really don't want to speculate on what they could do.
Yeah. I think the important point from that is that they are potentially looking at the framework, which adds a little bit of extra risk on top of what they may actually do on monetary policy. It's all about maybe moving the goalpost within the framework, a bit like the Fed going to AIT. Look how that turned out for them, though. You know, making some shifts to try and justify what they do, or to give themselves a way out. So it's a bit of an extra risk in terms of what may come from the Bank of Japan, either from this or from monetary policy, as we roll into 2023. Moving on to the RBA, Kay covered the ETF comment from the Bank of Japan. So moving on to the RBA, Low was out. Inflation expectations in Australia still well anchored, and domestic spending is resilient so far, in terms of seeing higher rates. So not seeing any big knock-on effects from higher rates on spending there. ECB's Lane. There was a survey of professional forecasters out, and he said that showing long-term inflation expectations at 2.2% is significant for monetary policy. So again, keep emphasizing how expectations for inflation are just as important for a central bank as what the actual inflation numbers are. They want to keep inflation expectations, particularly the ECB, contained as well, because if they start taking off, it becomes a bit of a self-fulfilling prophecy that you get inflation following, because firms think prices are going up, they raise their prices, then prices go up and inflation goes up, and then they think prices are going up, so they raise their prices, and then inflation goes up. You get the picture. So that's why expectations are big for a central bank. Now, 2.2%, that's just a couple of pips over their target. So the fact that it's significant at that level shows the thinking from the ECB. He also said real rates have moved up quite a bit. Now, there's, everyone remember Brexit, that funny old thing we had some 6 years ago that's still bubbling away?
No.
Yes, Brexit. Well, as we've been noting on the show over the last few months, there has been some noises that the Northern Ireland Protocol and the stuff going on with the hard border between Ireland and the UK, maybe things might be thawing there a bit. I think it was a couple of months ago, we had that the EU were undertaking certain checks that fall in line with what the UK wanted, and things were easing, so on and so forth. And again, it's another snowball that's been picking up, and it's been picking up the last few days as well. Von der Leyen was out yesterday saying that her contacts with PM Sunak on the protocol are encouraging, and a workable solution is within reach. She also said if there's a political will in the UK, they're very confident of a positive conclusion can be reached on the protocol.
By 2400 or when?
Yeah.
Seriously. Yeah.
Exactly. But Ireland's Coveney was out as well today, pretty much saying the same sort of lines, that a landing zone on the protocol is possible within the next few weeks. The UK and EU is in a better space than for some time, than it has been for some time on Brexit, although they haven't made any major breakthroughs on the protocol. But it's all sounding a bit more positive on that front. I don't suggest that this is a huge price mover for the pound, but I think it's possibly a bit of a secondary tailwind to what's happening in the quid. Just generally, we're seeing euro sterling particularly a bit softer. A quick look at that. Looking a bit softer now at the moment, coming down a bit faster than it has been going up. So just need to keep an eye on the levels there as we move down. I think, as I say, I don't think this is huge news, but everything that's going on, particularly in cable, just a secondary wind for the pound at the moment, if we get good news on that. Over to the Fed, Bowman said headline and core inflation have slowed slightly but remain unacceptably high, expects ongoing increases in rate hikes, still have a lot of work to do, appropriate for us to slow the pace of increases, and expects we'll have a slightly higher terminal rate than had anticipated in September. Fed's Williams also out. It will take a couple of years for inflation to ease to target. A bit of a nod there to maybe how long they were going to be keeping rates strong for. High inflation is not yet embedded in the economy. Seeing signs of a welcome ebbing in inflation, but unsure if it has peaked and have a ways to go with rate hikes. Fed's bar, pretty similar, not now at the point where we can pay more attention to the rate we are getting close to and less on the pace of hikes, and the Fed may shift to a lower pace of hikes at the next meeting. So again, all singing off the same hymn sheet pretty much, that rate hikes are going to dip potentially to 50 basis points in the next meeting. And we've got a replacement. Chicago Fed's Evans is going to retire in January, and they've named Austin Goolsbee as the next president. A lot of people running around. Is he hawkish? Is he dovish? A couple of comments he's made have been that he said that the Fed being aggressive could trigger a downturn, but it kind of makes sense for them to get inflation and inflation expectations under control. I don't know if you've had any more readings on him, guys. I don't know if we're going to get a hawkish guy or a dovish guy, but we're probably not going to get him till January anyway. Any thoughts on Austin Goolsbee, if I'm getting his name right?
Not my side.
No.
Good. Right, moving on.
Yeah. It's Friday. Let's get it done quickly.
All right. And a bit of press for South Africa. Then President Ramaphosa is further in trouble, apparently over stashing cash in his sofa from a farm theft 3 years ago. There's been an independent parliamentary review that says he faces some serious misconduct for his part in that. It did happen 3 years ago, so this has been bubbling a while, but he's potentially facing having to resign or whatnot. And dollar rand, which I'll let Kay look over, had a nice little ramp up yesterday. Right, that's it from the news and screws. Let's get stuck into some of the pricing stuff. Do you want to talk about the NFP before we get stuck into the charts, lads?
Yeah, I mean, we have an indication now, like you said, that anything below 100K is going to be looked at by the Fed as being worrisome. We're expecting 200K. Previous reading 260. We saw ADP, not disappointing, but missing a couple of days ago. chances are, with the whole general theme of economic data disappointing, chances are we're probably going to see a lower number. By the way, my guess is 69K. I like to be on the a little bit extreme, but
no, that's not. Come on, Stel. That's not extreme. That is a well-chosen number.
That's a Steve number. That one, yeah.
True, but we know that NFP can be very volatile. So you know, anyone's guess. I'll be looking at the average hourly earnings, expected to go down 1.1%. But overall, you know, I do think that the chances are it's going to miss, but probably the whole market thinks that now. So I don't know which way around I want to be going into the number.
Yeah, I'm not going to be any which way. It's a complete lottery. This thing can come in as much down 100K as it can come in up 500K. That's the beauty of this number. Kay, what did you go for in your guess on the competition?
111. Very close to Powell. In J we trust, mate. No, I think, you know, we've been talking about it already for a while, that sooner or later it's going to the job market should catch up with the slowing of the numbers. But then the jolts didn't really. Okay, they've come down a little bit, but the ratio is still pretty high. Is it what 1.7 still also? Between offers and demand. So sooner or later we will have a bad number. Is it this month? It's December. Anything can happen. But yeah, I mean, we have to, let's put it that way. We have to expect sooner or later a weaker number, and it could be today. And if you look at what it could mean for markets, as you already said in the beginning, well, call it pivoters or bears have the dollar in control right now and get any weak number, and I guess we are going to end the Friday on the week on a very, very weak note for the dollar. And we will have a look at them. We are on levels, right? We really are on levels in quite a few instruments, not only FX but other stuff as well. We are on levels, so there's going to be. I can't see it not move this afternoon. Let's put it that way. A very, very good one could come as a surprise in this case, I would say, and then we should have some relief rally, but to where it can go, that's a big question today. And there I join what you said at the beginning of the show, is that I think the bears are going to try and keep control of these moves in dollar, and every reasonable retracement, which in today's relatively volatile market could mean up to 1%. We can't rule it out, right? I mean, dollar yen is trading 134. We could be trading 135.5 on the number. People need to keep that in mind. I was trying, just for a little in between, I was trying to buy overnight dollar yen just for a quick try. The thing is somewhere 17 or so percent. It's costly, so the market still expects big moves.
Yeah, exactly. I think that's some very pertinent points there from you, Stel. I agree what Stel says. The surprise is a bigger number because the market is looking at all the data coming through, so it's probably looking for a poor number. That means we know our price risk potentially is on a good number. All those expectations get blown out the water. Now, as much as I've said, I think any rallies get sold into, we have to look at how far we've come. As Kay mentioned, you know, dollar yen has absolutely cratered. We've done what, nearly, what are we looking at? Where are we? Let's go into, why am I in that one?
From where it really started, right? No, take away the interventions, but really we've been.
Well, just take from Powell and the end of month, we've done, you know, nearly 500 pips, over 500 pips. That's a big move in anyone's money. So even if we get a good NFP, as much as I say that the market will hit a rally, there could, you know, we could see it back to 136 before people start stepping in, maybe 137, because we've come a long way already. There's good, how should I say it? There's good chance that we get a lot of profit taking, and then we have to see next week. We come back next week, and that's probably when we start to see it drift lower again as we get further data. So it could be very volatile. Now, how do you look at the numbers? Because it's always important to gauge what to look at, because there's 7 different metrics we need to look at. So first of all, we've obviously got the headline number. That's going to get the initial reaction. The second number is going to be the unemployment rate. Okay, if that ticks up, that's bad news as well. So if we get a poor headline number and we get a high unemployment rate, you've got 2 things now that are negative, and we're likely to see the dollar sold off, yields drop again. But you have to take into consideration the participation rate. It's very important, because if the participation rate goes up, it can mean that the unemployment rate can go up, and vice versa. If the participation rate goes down, the unemployment rate goes down. So you have to see whether a move in the unemployment rate is a true reflection of it growing or not. So let's say we get a number that's 300,000 on non-farms. That's a good number. Let's say the unemployment rate drops to 3.5%. That's a good number too. If the participation rate has dropped, that means more people have come out the market. That doesn't mean that that unemployment rate dropping to 3.5% or whatever is good. So you have to take that participation rate into consideration when looking at the unemployment rate. On from that, look at the wages. What are wages doing? Are they growing? Are they trying to catch up with inflation? So look at that from the inflation perspective. If that drops as well, then we're following the trend in inflation. That's taking more price pressures out of the inflation picture. But if it rises, it potentially means it's going to keep some inflation in there. So the 4 main numbers there to look at, if you're not experienced on the NFP, that's how you work it. Obviously, if you're in the chat room, we'll have all that covered, and if you're watching on the live blog, we'll have all that covered and explain what each number means as it comes out. Canadian jobs, as we said, look at that from a secondary perspective. If you're trading the loonie, it can act as a double wind or an adverse measure, competing measure, if you like, offsetting. So you get a good NFP, a bad Canadian jobs, then you see dollar CAD rising. If they're both good, the US is going to edge it probably, but it's a bit more neutral. So you can get double wins each way for that. It can be a good pair to trade over the jobs picture if you get them both going in opposite directions, because it magnifies the moves there. And then if you hit some key levels, stretch points, can give you some good entries. So keep an eye on that one there. It was a bit of a gangbusters one, wasn't it? The last one, if I remember rightly. Where are we?
Yeah. It was a big one. Came out much bigger than expected, and we had some strange reactions right after the number as well. And Canada strengthened, but then it stopped, reversed, and then we took the right way again. But yeah, it's been a bit of a it's actually a number that was welcomed with a bit of disbelief, if I recall well.
Yeah.
As well. We were saying that, where does that come from? You know?
Yeah, I think there's maybe a bit of a risk. We see a bit of a washout.
Yeah, I think there might be a bit of a risk there. Yeah.
But on the flip side, if we get another strong one, yeah, it's going to be. If we get a poor NFP and a strong Canadian, that's going to see the loonie probably plummet. Anyway, there we go. So that's how I look at the data anyway. Let's get stuck into some prices at last, and we're going to start with dollar yen. Now let's go into this one. It's a bit more clearer on the daily. Let's come out there. Right, so we've got some big fib levels coming up. I mean, it's pretty much carved through tons of tech on the way down. I said, 400 points, 500 points since Powell uttered his words. So the tick isn't standing up to anything. I had a little long attempt, a little separate long attempt here at the 200 moving average. Got done on that one. The next area I'm looking at is in towards these fibs, because these are fairly decent fibs of the big moves we've seen from the 102s and this swing up in March this year. So it's a bit of a confluence here, 133.30 down to 133.09, called it the big figure. So in terms of seeing whether we are about to really change this trend, or whether this is just a bit of a correction, these are the big levels that I tend to look at. If we get under there, we could be heading all the way down under 130 and maybe even more if the worm is turning. I'm still short from my post-power trade, so I'm happy just to run that down and pull stops behind it. I'd like to have had a bigger build, but Mr. Powell never gave me any entries, but I'm going to try and sit in this one as far as it goes. But big levels down here. I may look to try a separate long just to play the tech down here. If you're going to try catching a knife in situations like this, have a good reason to do so, but respect the conditions, respect the volatility, respect which way the wind is blowing. I'll be keeping my risk low and keeping my stops tight as far as that's concerned. But as Kay was saying, you know, given how far we've come already, big number, we're hitting levels. This could be one area where enough's enough for dollar selling for now in this pair. So if it's a bad NFP and we can't break this area, I think we're potentially going to see a bit of maybe some profit taking, a bit of a bounce from there, just as we're going into a weekend purely on that basis. So again, that's an area I'll be looking at there. Just to go over a couple of the other trades I'm in, Aussie dollar, longs ticking over. We've got the break of the 68 level. It's huffing and puffing a bit up here. My next level is up at 68.50 before we start again getting into some of these big fibs up here. So we had the highs. It's not quite getting up to the highs. We're holding 0.68 67.90. That's sort of the area, the important area right now. I did take a break long, or I did buy a retest of 68 yesterday, so I'm keeping hold of that. I'm playing a bit on the shorts, playing a bit for short term. I've already knocked some out, 68.26. Looking to see if we can stay above this area, as I say, 67.90, 68, and push it on. The data is going to be a big one for this as well. Just want to look at stocks because, again, as we mentioned, we're hitting some levels, and you know, having the discussion about whether, you know, stocks are going to start reflecting the fundamentals rather than the potential for QE. In my mind, this move in stocks looks to be significantly based on purely the tech levels. 41 has been a prior area. We've hit this trend line here as well. So it's become a bit of a, you know, natural point for the market to take a bit of a pause and say, okay, you've done enough for now. Maybe the NFP unlocks it. If it's bad for another leg higher, we break through the levels and off we go, 42s, 43s, whatever. But for now, big tech level, this is why I think it's holding here. The market, the techs are working now. Techs didn't matter all through here, but potentially they are now. What do you make of it, guys, at the moment? You know, we've been talking about stocks and rallying and stuff, and you know, what do you do with these big levels going into big data?
Personally, I don't do anything going into big data, but I think you're right. The S&P is at resistance at very, you know, very important levels here. Payrolls is going to be the catalyst for the next move. You know, if we break above, then 4,100 is easy, and you know, a lot of people talk about 4,300. It will depend on what the Fed does. Also, one thing I wanted to point out that we didn't talk about earlier is what the market's pricing in for the Fed now. So we're pricing a rate ceiling of 485 by May or June, I think.
Still up there.
2023, yep. So 250s basically, okay. And then, interestingly, we have pretty much 225 cuts by end of December. That's the one that I'm having more trouble with. But you know, just
have you got that on your screen, mate? Because I know you look at the
yep,
you got that on your screen currently. Do you want to just take that to show people what?
Yeah, of course. Hold on. Continue. So these are Fed fund futures. So 100 minus the price that you see here for each contract gives you what rate we're expecting. The low, which is May 2023, 95.14, so 100 minus that is 485, 486, call it 485, just nice round numbers. And then if you go down, they start increasing, which means rates start going lower. And by December, it's almost too high, 2 cuts, and by January, it's 2 full cuts. So just something to be aware of, and then we continue after that. But then it's anyone's guess. But these monthly Fed fund futures are really nice because it gives you a granular view of what the market's pricing for each meeting. And this is actually something I used to use a lot when I was market making dollars, because you can literally understand within a basis point of what the market's pricing for each meeting.
I've put the page again in the chat. I did it last time as well when you showed it, because I think it's an absolutely fantastic page to look at.
Yeah, I have that all the time on.
Yeah,
but
agreed.
So I mentioned this because you have to be aware of what you are, what you are thinking. What's your win scenario if you take a trade? Obviously, if you take a day trade or a quick swing trade, that's a different thing. But if you take like a more long-term trade, what is your scenario where you win? What's your scenario when you lose? So if you want to go long equities with a longer time horizon, you really want the Fed to stop hiking when the market expects them to stop hiking, and actually indicate that they're going to be cutting afterwards, because anything less than that, then the market's going to reprice. Rates are going to go higher, and we know the correlation: rates higher, stocks lower. Obviously, nothing moves in a straight line or one-to-one, but that's a general direction. So that's, if you want to go long stocks with a longer time horizon, this is what you want to happen. Alternatively, if you want to go short, it means that you want the Fed to be more hawkish in the market's pricing, and it's a tough call. It's a tough call with Powell saying what he said the other time. Although it wasn't groundbreaking, I think it was kind of perhaps preparing the ground for slower hikes, maybe a 50, maybe then we go to 25s. I mean, who knows, right?
Yeah, exactly. Yeah, I mean, the current pricing, I was actually expecting to see a flip on the pricing between pricing 50s and 75s to 50s and 25s, but we're still pricing a 9% chance of a 75 at the December meeting. Maybe it'll be the January projections that sees that flip to 50, 25. And as you say, it's just about where the expectations are sitting. Like you say, from those CME numbers, the market expecting cuts into the end of 2023. Well, if the Fed aren't going to do that, then there's potentially a trade, because the market is leaning one way, and you've got an opportunity to take the other side of that, depending on how you assess the data and the views from there. Right, just one other pair I wanted to look at quickly, and then I'll hand it over to the Cayman, which was $1. Still doing a bit of scalping in this one. I was long 702 yesterday, managed to get some away, then got hit on my trailing stop on that. I'm in again, an OK's in at 701. I'm playing the 7 level. Well, you're playing it a bit further down, I think, on your K to 696. I'm going to be gone at 698. I'd rather go small and then try again, and small and try again. Give myself too much room. So I'm in at 701, a bit more just ahead of 7, and we'll see how it goes. Again, you want to try catching a falling knife, then look for the big levels and the reason to do so, but respect the risk there. So, Kate, I'll let you take it for a quick round robin. And while I'm doing that, there's a question from Mavi. I hope I got your name right. Thank you very much for your kind words about the flow show. However, you want us to start earlier before the London Open.
Impossible.
Love to, but no chance, mate. I've got family and kids to get up and get to school that time in the morning, and I wanted to do the show after we've had all the European data, so we can look at it, so we can assess it, and get stuck into it as a bit of a review. So, unfortunately, no, we will not be changing the time, mate.
No,
thank you.
And those who don't have kids, we're still nursing hangovers from the day before, so no way we're doing it earlier. No, I'm just joking. Yeah, so Ryan already said a lot about the dollar yen. I just wanted to highlight a couple of levels here. So we have this 200 DMA. I think this is going to be relatively important. It's 134.50, let's call it there, to see where we close the day. There's a couple of interesting levels here, 133.30 and then 133.06, which is 38.2 of the whole move from January 2021 to October 2022. The 38.2 is at 133.06. So there's a bit of levels there in the 130, in the low 133s. Then we have a bit of traffic there in the mid 132s. But as I was saying this morning in the chat room, and here on the flow then a bit earlier about corrections, a very, very good number would be, in my view, a bit of a surprise. So this could take us back to 136.40. Why not 137 before it goes back down? Because if you look at the volatility we have right now in the dollar yen is absolutely crazy. I was trying to buy some short-term options, but I just let it go because it's got to be too far out to be reasonable. So it starts with 134.5 and then 135.5-ish here. Those are going to be levels that I'm going to be monitoring in the dollar yen. I did catch a very small pocket knife on that drop this morning down to 133.70. I got it around there, and then since we corrected a little bit early today, I took half of it off. So my average is now actually very close to 133. So I'd say that if it goes through 133, I'll be out and reassess. This being said, if we really have a very strong number and we get back up to, let's call it wildly, 136.5, 137.5, I will take profit and probably try to get short again, because as Ryan rightly said, the bears are very much in control. And if you look at yen crosses as well, especially in the yen, you look at stuff like euro yen, it's broken lower. You look at Aussie yen, it's broken trend lines as well. So the yen is still very much the flavor. Now, with every opinion comes a bit of a picture, and we have to look at those yields, especially the 10-year yield, because that's where the yen is paying attention to. So we are below October lows in the 10s, 356. We're trading around 350 right now, 351. So keep a close eye on where those are going to close. If we get a surprise number to the top side and we rally, let's say 10 BPs back up to 363, and we stop and we come back down, that's going to be bad news for the dollar yen. Okay, if we manage to, let's say, close already above 358, but I mean, ideally above this 362, 363 in the 10s, then we may be in for some more correction in the dollar yen. So whatever happens this afternoon on the takes and stuff like that, watch what happens on the US 10s to know where dollar yen is likely. Nothing is ever guaranteed, but likely going to end the week. So that a bit. For the rest of the currencies, I would rather, perhaps for the euro dollar also, I would rather look at the twos, because they are doing some funny things as well. We are sub October levels there as well. We are trading in the twos around 420, which is, in theory, well below where the terminal rate should be. So get a move down to 4%. I may try to catch a knife perhaps there, because I think we are going to be out of sync with where the terminal rate should be on the Fed. and that could be an overreaction. Of course, everything depending on the numbers, right? Cable. We've been talking about this 123. It's a prior high from August. Yeah, it's also that's cable. It's the high that we tested yesterday. We are a little bit below, but we are not that far off, right? We are trading at 122 3/4. Watch that 123 in the cable. I think it's worth look at this. If you look at it on the daily, it's worth 200 points if it really breaks above and stays above. On the downside, there's the 200 DMA, which is waiting for us at 121.5. That could be enough for a correction if it comes down there. It's also the prior high. So the 121.5 is really going to be the level to watch on the downside on the cable going into this afternoon. It's pretty big level. Euro as well. I have this from the 115 drop to the lows. I have 105.16. We are just slightly above. I think that's a decent benchmark for the close of the week. If you're above or below in this one, if you're above, I think there's a big figure waiting on top side. Why not even more? 107.40 if it's really stupidly bad numbers. If the numbers are really good, there may be a case of if you break sub 104.80-85, there may be a case of going down to quite close to 103.5 before reassessing. We have to look at the metals as well, because they are pushing through. They really very much liked what the yields were doing. We are in the zone here, 1800, 1807, and there's a bit of a trend line here as well, up to 1815. So 1810, 1815, this is really the zone that we need to watch. If we start to really break it, then we get back into this heavy traffic zone that we were observing on the way back down from the highs before it finally broke lower. So 25. Oh, it's like it's $30 wide, this zone, 25.55, but it could get up there if we get. And in my opinion, it should be a weak number, but not a disastrous number to get the metals going. If the number is disastrous, and that's where my reflection comes into play, I think metals may actually underperform, and especially this one. So silver, we did break the trend line. We did break the 22 figure 15, very nice. I did shave off just a tad of my long-term positions just to get room in those longer term positions. So on this way up to 60, I shaved up off a little bit. So if it comes back down to perhaps low 22s, 22 figure-ish, providing the number is not overly bullish dollars and we get a move back down to 2130s, I think a good number could actually mean a little better for stuff like silver. Here, Kiwi's been really doing very well. There's a lot of divergence still in play with RBA, and the RBA being a little bit more mellow than what the market was expecting. Aussie Kiwi is really taking a dive, but in the Aussie Kiwi we are on very interesting levels now. I think this could go to 64.5, 64.70, but then I reckon we should be reassessing a little bit. Get back below 63.75. We're a bit close for comfort, but perhaps 63.10, 62.85 are going to be levels to watch. And then I'm looking at the clock, and it's really getting late. But I just wanted to change to show this. Aussie Kiwi, that's the one that I'm looking at, and I'm going to look at this quite closely on the close of the week, whether we stay below or get a close above 106.60 on the Aussie Kiwi. I might start to get a little bit interested. If we really close below, then I reckon we're on our way to 105s. But it may start to look interesting. And I'll give it back to you, Ryan, because we're really running out of time here.
Yeah, thank you very much, mate. And yeah, we shall call it a day there. Thank you all for coming to the Flow Show this week. Hope it's been of use to you. Please trade safe over non-farm payrolls. If you had a good week, don't go and spoil it by having a gamble on the NFP. Close it up, take a early weekend, enjoy your hard-earned pips, and have a great weekend, everybody. We will see you on Monday. Have fun, stay safe. Thanks to Kay, thanks to Stel, thanks to all the FA crew for putting this together, and have a great weekend.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.